You're self-employed. You're building something, and somewhere in the background, the government is collecting $9,292 from you this year in CPP contributions once you factor in the second additional contribution on top of the base. What do you get back? The 2026 rate card saves up to $1,500 a month at retirement, but almost nobody actually hits that number, up to $1,741 if you become disabled, and $925 if you're an average new retiree. I'm going to show you exactly how these numbers break down using the official April to June 2026 figures, because once you see the math clearly, you can decide how much of your investment strategy needs to exist completely outside of what CPP will ever pay you. Hi, Kane again. I graduated from theater school with nothing. 20 years later, I own properties throughout Ontario. It took a lot of hard work and tons of mistakes. Watch my biography video to see how I struggled. This video is for educational purposes only. If you are seeking to invest, be sure to speak to a professional. Look at my references to see where I pulled this information from, and if there are any discrepancies, let me know. Without further ado, let's get started. So, let's read the April to June 2026 rate card the way you'd read the lease before signing it. The YMPE sits at $74,600, and that's the income ceiling for your base CPP contributions. But the YAMPE sits at $85,000, and that's the ceiling for the enhanced CPP layer on top. Any income earned between those two numbers gets hit at the enhanced contribution rate. So, if your business income runs at above $74,600, you're contributing at both rates until you hit $85,000. And that band between the two ceilings adds another $832 to your annual liability on top of your base contribution. Below $3,500, which is the year's basic exemption, nothing gets calculated at all. A regular employee never feels the full weight of this because their employer covers half. Each side pays a maximum of $4,230 on the base. So the employee's out-of-pocket stops there. When you're self-employed, you're the employee and the employer at the same time, so both halves land on you. And once you added the second additional contribution on top, the full $9,292 comes out of your business cash flow. That's not a punishment, that's just the structure of the program. But it does mean your cash flow planning needs to account for it in a way a salaried person never does. One practical thing worth noting for your quarterly installments. The January 2026 maximum set the baseline for this entire year, so the rate card you're working with right now is the same one that applies in June, with no resets in the middle of the quarter. That removes at least one variable when you're doing tax holdbacks or projecting your cash flow positions for the next few months. The government does raise CPP payouts by roughly 2% annually to keep up with inflation, and the 2026 figures already include that adjustment. But that annual bump is a standard cost of living increase applied to benefits already in pay. Not the same thing as the structural enhancement that raised the replacement rate and the contribution ceiling. The enhancement changed the architecture of the program. The 2% adjustment just tries to keep the payouts from falling further behind real-world costs. And based on what rent actually runs in most Canadian cities right now, it's not catching up. On the disability side, the maximum pension sits at $1,741 a month, which runs higher than the retirement pension. It's built from two parts, a flat rate portion of $610 that everyone gets if they qualify, plus an earnings related portion of $1,130 that depends directly on how long you contributed and at what income level. If you contributed at lower amounts in the years where your business income dipped, your actual disability benefit comes in below that $1,741 ceiling. And if you've got a family depending on your income and something happens to you before you retire, that maximum survivor benefit of a spouse under 65 is $803 a month. That's what a young family would actually be working with from CPP if the worst happened, which is why personal life insurance and income generating assets outside of CPP aren't optional when you're self-employed. You've paid up to $9,292 into the program this year, and the retirement ceiling on what comes back is $1,507 a month at 65. But the government also publishes the average retirement pension for new beneficiaries, and that number is $925 a month. Most people skip right past that and only remember the maximum. The average is the more honest figure for a self-employed person whose income moves around year to year, because hitting the maximum requires contributing at or above the YMPE for most of your working life, and a lot of self-employed people don't do that consistently. Once you have $925 sitting next to $1,507, the gap between your own investment needs to cover becomes pretty hard to ignore. So make sure your investment strategy accounts for that gap, because $925 a month doesn't cover the rent in most Canadian cities, and it definitely doesn't cover a mortgage. CPP was never designed to fund your whole retirement, and a 2026 rate card doesn't pretend otherwise. The enhancement is real. The numbers did move up, but you're still setting $9,292 into the program, where even the maximum possible payout of $1,507 a month wouldn't cover a one-bedroom apartment in Calgary, Edmonton, or anywhere close to a major city. And the average new beneficiary is collecting $582 less than that ceiling every single month. If you've enjoyed this video and want to learn about the best passive income investments, watch this next video here. Thanks for watching.